We have seen far more borrowers that were in distress curing their mortgages than historically. We have seen the ability to file bankruptcy to stall the foreclosure process actually become a tactic for a modification. That's where I really start seeing pockets of opportunity. And so a lot of infusion of processes and systems must come into the space.
Welcome to the Debt Doctor podcast, where we deliver the definitive prescription for navigating distressed real estate debt. I'm your host and America's most qualified debt doctor, Bill Bymel. I've spent my career investing in, diagnosing, and reviving thousands of distressed real estate situations. The Debt Doctor prescribes proprietary remedies to help you identify, acquire, and monetize undervalued real estate assets. Each episode gives you insider access to the strategies top cohorts use to transform market volatility into double-digit returns. If you enjoy what you hear today, hit the follow button, subscribe so you don't miss an episode, and please share your support with a quick review. You can find me on the web at billbymel.com. Thanks for joining this episode of The Debt Doctor. It's an interesting thing that is happening in the office space. I just heard one of the major private equity funds is shorting commercial real estate REITs, especially office REITs. And why? Because they're one of the largest commercial office owners in the business. And they see that what's happening is when these leases are coming up, people are downsizing. Just like what you were saying as we were coming on here, that there's with technology, even 5 years post-COVID, it is a new era, and that is for sure.
We've seen a bifurcation of operators that have capital in residential, have capital in commercial and multifamily, and we've seen a lot of guys flighting to distressed commercial, especially office, in major metro areas throughout the nation. And because of that, we've seen challenges in private credit raising of capital to come to resi, because a lot of folks are flighting to commercial because of the downpour of vacancies. I mean, right. I can't tell you the amount of Class A buildings that we've seen even here locally in DFW, that if you get off the elevator in the wrong floor, you may see the entire floor empty.
It's a ghost town.
You're like, where's the cash flow coming from this building? And how are they able to upkeep, right? Just the maintenance of the tenant expectation alone. And so, look, we've seen as you highlighted, the automation and the technology that are coming into the workforce now. Like, do I physically need to drive 30 minutes into the office each day, right? And that 30-minute commute back to still get I can get an hour more of not only output, but save the time of getting ready and all that jazz, right? That goes into it. And I'll tell you, it's been more of a challenge on the younger workforce, right? Your folks that are coming fresh out of college, 22 to 26, it's really tough to immerse them into the culture, right, of your business. And
yeah, how do you mentor the new people if you can't really be there physically? That's the counter argument to this whole remote work thesis, is you're losing out on all that mentoring, both from an employer point of view, knowing that your people are there, that you can physically, interact with them. But it's really as much for the next generation, without being present, without overhearing those conversations they maybe shouldn't be hearing, or that they wouldn't normally be part of, without being there to interact on a daily basis with their cohorts, their peers, and their superiors. The next generation faces a real uphill battle, other than relying on their little chat GPT buddy.
Sure.
And I don't know what a world like that will look like.
Look, we're seeing companies get better at standard operating procedures and the implementation of those for new hires. And getting it interactive and making sure the training modules are getting better. But come on, right? That the best way to train is to mirror and to watch and to see.
Right.
And it's hard to do that without technology. And so I will say though that I don't know how long that story is going to last in a few years, man. We've seen a lot of folks kind of pushing back against this narrative, saying, look, we can get far more done rather than physically getting into the conference room
Right.
or meeting in person to still get 3x 5x more output from that same person. So
There's definitely a hybrid model that's coming into play that is working, and the companies are finding balance with it. And it is a new world. It's going to be a new way of doing business. We don't go to local shops to work, or the way that the world of work 100 years ago is much different than it is 50
mhm.
years ago. It's different than it is now, and it will be different again. And it's those that have resilience and adaptability are the ones that win. Well, Chaz, speaking of resilience, adaptability, you and I were in our 20s when we met. I mean, I think maybe I was in my 30s. I don't know. It's quite a while ago.
Seasoned.
Thanks for joining the Debt Doctor, by the way.
Thanks for having me. This is awesome.
Um, we have spent many years doing business together, speaking on panels together, growing up together. I probably have a few years on you. And your company, Revolve Capital, you're based in Dallas. When we met, you were selling loans at another company, and then you went on to become a partner at another company. I mean, you and I have been the guys that seem to keep showing up in this non-performing business, even through the last 10 years where there hasn't been as much NPL. Is that a good way to put it?
I felt like you had a firm anchor already in the space. I think you saw a lot of the distress wave in 2007. I think '08 and '09 emerged onto the national stage. However, we saw ripples, especially where you were at the time in Florida
Right.
and Fort Myers and all these
Port
areas
St. Lucie.
that were Port St. Lucie that were leading the charge of the distressed environment that was coming. And I will say that my start in the business is unconventional.
Mm-hmm.
And it did start more on the smaller investor side where we noticed that the business was so fragmented. There was no trades or transactions in terms of sellers and banks trying to move product off balance sheet. The way they were liquidating was not to smaller investors. They were to
Right.
institutions and other banks and lenders. So they were doing that in volume, and nobody was doing that in smaller bite sizes. And so yeah, I think from a scale and an operational oversight, it's going to be a challenge. However, we began to operationalize selling to a smaller investor that could buy 3, 4, 5 at a time versus trying to move 50, 100 to 500 at a time.
Right.
Right.
Making
So,
a little arbitrage off of buying in bulk and selling in smaller quantities
you know,
to investors, local investors.
so I would say, most of my early career, you were selling, theory and strategy. You were selling actual properties, right?
Mm-hmm.
Training investors on how to underwrite and, manage risk and extract value from these complex deals nationally, right? And that's the foundation of how we, manage Revolve today. And so, seeing the scale from '07 right to where we are today in the mid 2020s, and where I think we see technology going into 2030. Bill, I mean the evolution of the space has come light years. The amount
Yeah.
of transactions you and I can do today with not actually having to see one another
Mm-hmm.
or even hop on FaceTime. Our two trade teams can do tons together, and our
Yeah.
asset management teams can face each other. So it wasn't this seamless,
True.
15 years ago.
Can you imagine if we had the technology at the cost that it's now able to be created, if we had that, 15 years ago? And I guess from my perspective, I'd love to hear what you're doing, but I'm certainly like, I'm not going to be that old dog. I want to learn the new tricks and incorporate our old world knowledge, our 10,000 hours into the new wave of technology that really, can revolutionize it, can make this industry even more and more efficient.
We have seen, let's just give you one example where we've seen AI and automation coming into the servicing world, where you are starting to spot delinquency before delinquency happens. I'm sure you remember that movie with Tom Cruise, where Minority Report, where
Mm-hmm.
they were trying to predict crime before the crime actually took place.
Right.
So today in the default servicing world, as you notice, a lot of the delinquency you get notified after the delinquency has happened,
Right.
not prior. So a lot of the manual lift that happens in the business on pay history tracking and servicing comment tracking, especially if you're receiving it from multitude of servicers and having to uniform that data and then have that data componentized into your system so you can start to track behavior. That is where we're seeing real lift in terms of technology coming into the space, where historically we've hired those people, right?
Right.
People had to spot and watch reports and track trends by eyesight, where now we can have that done in a fraction of the time.
Yeah.
So this is where we're starting to see, the institutional automation side coming into our business. That is, it needs it. The lack of fintech and the lack of, we're still printing documents and having to wet signature, that is bottlenecking processes throughout, right? We're having to wait over weekends to open escrows,
Right.
right? So properties can liquidate. So I think a lot of lift still needs to happen, but
I
I think
agree.
we're heading in the right direction.
I agree. I think there's more efficiency to be had, and there's different um, paradigms about how the business should be managed and operate that are being broken. I mean, just look what's happening on the realtor side of the world, the MLSs and the fights with Zillow and and all of the breakdown of the realtor MLS monopoly. Which I have mixed feelings about the whole thing. Because part of me I had a father for a real estate broker. So, part of me is always sold on the old world way of doing things, that there should be two sides of a transaction, that it all seamlessly works through a system that, the realtors have agreed to through the MLS. And, I mean, but I understand why you would want to break that up as well. Um, it's a very interesting time. And being someone like yourself who's been around this business, residential real estate, mortgages, performing, non-performing, secondary market, you've got to have some unique, perspective that maybe others in the space don't see. Have you, what do you think? What makes you an outlier in terms of where the industry sees things? Anything in particular?
We have seen far more borrowers that were in distress curing their mortgages than historically.
Mm,
We have seen the ability to file bankruptcy to stall the foreclosure process actually become a tactic for a modification.
mm,
The amount of equity protection, the loan to value in these delinquent loans, we're seeing, if you track the last half a billion, right? Just, use a round number. If each loan is $100,000, just for round purposes, call it, so the last, 500 units, right? Then you're saying to yourself, what does the equity look like on these assets, and how long have they not paid? So roughly around 65% loan to value, 35% equity cushion that haven't paid in 36 months.
wow.
So let's say COVID caused the default and you've been puttering around with forbearances and modifications. Eventually, when you look for something to stick, because look, the wage gap and how much it costs to Uber and DoorDash today in relation to what it was 5 years ago, it's not keeping up pace with folks' salaries. So
Right.
the affordability gap is not only shrinking, it's widening. And so
Hmm.
because of that, a lot you would think are going to go into foreclosure, which they are, but they're filing bankruptcy, they're modifying and staying in the asset. So you would think that a lot of these that are in distress are not going to resolve. I actually think the counterintuitive. Now, that's not a blanket statement, right? There's pockets.
Right.
I think the Midwest, all the way through the southeast of our country, so Ohio-ish, Indiana, Illinois, all the way through the Alabamas and Florida, I wouldn't say that rings true, right? I think the coastal markets, I think parts of the South and Texas and Georgia, I think would speak to modification success story. But I think that we've got a real affordability gap still coming. And this is where I feel that, with the lack of automation and technology still not applying in the servicing world, you're still going to have a gap for many operators in the space, because the folks that are asking, hey, look, give me a deed in lieu or a cash for key or do something with us, right? You're seeing the higher rate of divorce today, Bill, than you saw 5 years ago.
Wow.
And because of that higher rate, you're having a lot more cash out refinance. You're having a lot more folks that are trying to hold on to property because they have so much equity, but they can't make the payment.
Mm-hmm.
So where is a lot of this value going to be unlocked? And this is where I would say that this is the real lift of where SaaS can come into
Mm-hmm.
our world to unlock the manual lift. We just came away from a servicing conference, the Housing Intelligence Servicing Conference, where AI is trying to really get a beat on borrower behavior and patterns that live there. And if you saw the amount of lift that's still happening from a personnel standpoint, Bill, this is why a lot of these modifications are not being done. They're being done roboed. They're not being done common sense underwritten,
Oh,
right?
interesting.
You're getting 40-year amortizations, right? You're seeing these 50-year mortgage discussions. You're getting these 40-year amortizations, these 4.5% rates that folks still can't afford.
Right. If you got to let those people fall off, they got to be forced into a resolution. Can't keep kicking the can down the road because rates are not going to go that significantly down from here. We're still below, historical averages in terms of our rates. I was just saying how, in the 80s, when I was just a young little thing, my father came home with a 11.25% FHA mortgage, and my parents were ecstatic about it.
Felt
It's just
normal.
the perspective is all skewed, and it's interesting. I think that you're right. I think that there's a lot of hanging on, and maybe if the stock market sees some kind of correction or something else happens, it feels like the inventory isn't lacking. It's just being held on to by a class of baby boomers that are using it as as an asset that they're saving. And some of those are renting and they're upside down. Some of those have equity. I think you're right. I think there is a portion of people that will modify and figure out a way to get their situation right. But
Mhm.
we have to stop kidding ourselves
Mm.
about the people that can't afford at a 3% rate. Oh, they have equity. Okay, well, they still can't afford their payment. They need to move on, and there needs to be enforcement. And maybe shake a few of those, I guess, from the trees, right?
I think they know they're delaying home ownership eventually, right around the corner, which they could get rid of an asset. We've seen many that kind of bought off the COVID craze, right? The 22, the 23 equity spike craze appreciation we saw nationally. And now folks at 2 years later, 2.5 years later, are either flat or underwater if they had to resell.
Right.
And so that usually is not a trend in residential investment, right? And
Yeah.
especially when your home becomes your most key prized asset and wealth generation tool, right? You don't typically see you put 10, 15, 20% down and then have that erased in a matter of 24 to 30 months. So, you know, that's where I really start seeing pockets of opportunity where unlock a lot of this equity. I think a lot of folks need to sell their properties. I think it starts with baby boomers, and I think it starts with distressed asset homeowners that are sitting 2 to 3 to 4 years delinquent, waving at the two of you and I, asking us how our Thanksgiving Day holiday was, and haven't sent in a payment to their servicer in that amount of time. Wild. And so a lot of infusion of processes and systems must come into the space.
Right.
to say, there's been a massive allure on folks getting into general trade businesses, right? Your electricians, your plumbers, your laundry mats, your dry cleaners that have no point of sale systems that are done in scale. So a lot of folks want to start investing into spaces that have no real technology infrastructure to them. This is where I still think that there's kind of a correlation between our direct space and those same business models, where
Mm,
we're still needing better framework to happen in order for a lot of these distressed situations to make their way and get flushed out. For example, you and I both know there's at least 4 to 6 million of new home builds that need to happen to keep up with supply. But where's that supply happening? Well, shoot, people still can't afford a brand new home build. Rates are
right.
still elevated. That said, let it come from the distressed environment, right? Let it come from the 2 to 3 million units we know are sitting on balance sheet today that are 3 years delinquent and haven't been sold through.
Right.
So this is where I start seeing some of the unlocking of value that needs to come through different channels, where we're trying. I think you and I are trying to campaign for the voice to be heard. But
Yeah. Yeah. Like deliver. I mean, part of the mistake, I got why the government shut down foreclosure, but that starved the market of another million homes a year. And there was done as a protectionary measure, but then it became just kind of the norm. Didn't make sense, you know?
and
And if
and
you're complaining about that inventory gap, then you need to supply the market. You need to allow enforcement of debt that's not performing. You need to be realistic about that. The government itself is sitting on another million homes because they didn't enforce FHA, which is the Ginny product is like in the teens in terms of default. And I get it. We can't just continue to be and extend and pretend economy. And it's interesting you pointed to something, because there is a kind of a have and have nots. The people that are in the that are just very bullish about single family financing, and you get the Blue Owls of the world that are doing all this crazy HEI product. You've got the rise of HELOCs and seconds, which makes sense, because if you think about it, when you've got a majority of homeowners locked in a 3 or 4% rate, then the HELOCs or seconds might be their only access to capital. It's
yeah,
probably smart from an investment standpoint. I've never been an investor in seconds.
right.
I've always felt, because I come from the GFC where I saw all that stuff get wiped away, right? um there's this kind of like a general sentiment amongst the bulls in the business that real estate has so much equity. um but I feel like there's got to be somewhere where that falls short, because not every real estate, I mean, there's 14 trillion of debt, and maybe there's 35 trillion of real estate, but a lot of that real estate that's in equity doesn't even have a mortgage at all. Not everybody has a mortgage.
Uh-huh.
I think when you narrow it down to the mortgage, I don't know, where does that whole philosophy that these seconds and these HELOCs and these equity, where does that fall short, in your opinion, in terms of the safety and security of more unique types of mortgage products?
We have seen far more strategy playing out in the second lien space of selling the asset, especially when it has equity, rather than it having no second or junior lien. It's a first lien position, and you have seen ego and friction between borrower behavior get in the way of letting the asset be sold, and
Mm.
it goes to foreclosure, right?
Mm.
And so we have seen a counterintuitive borrower behavior where we've seen a junior, or we've seen an HOA that has tried to leapfrog us as a first, right, in a super lean state because they haven't paid their mortgage. They're not paying their junior. They're also not paying the HOAs of the property they're living in.
Right.
So all of these things have begun eroding into delinquency. We have seen a different borrower behavior when they do not have a subordinate lien, and it just can either sell the property, work it out, etc. So look, we have seen an increase though in unlocking of the equity position that most of these borrowers are sitting on through a HELOC behavior. And I'll tell you, those are also correlating with the development and investor side on fix and flip, bridge loans, where we've seen not only a craze in 22, 23, 24 in those, but now those are maturing and going delinquent. And these
Right.
were supposed to be low LTV originated assets that have kind of a quick exit built in once the rehab's completed, because you should be able to be selling in markets that have a fairly fast turnover in terms of liquidation. And here you are, you're seeing lender pools on fix and flip paper that have not only matured 6 months ago, but the extensions have been exhausted. And now that paper is now out for sale
Right.
at discount, right?
Right.
So I think those are cousin related delinquent paper trades that, how much dry powder sits behind those? I think a lot. Now, how much of it will be unlocked over the next 5?
Yeah.
Your and I guess is I'm sure you're a betting man. I know.
I was just gonna go there. I was like, wait a second here. We're gonna get into a bold prediction in a bit, but why don't you say, is that what you're looking at now? I mean, you and I are both bidding HUD Heckam, so there's a small, we take a little bite of each one of those auctions. Where else are you looking at? RTL, NPL? Do you feel like that finally the pricing's getting there? Where are you finding deals these days?
Yeah, look, we have had to be far more um,
Creative.
in our sourcing of, yes, deal flow, because we have good programmatic relationships.
Yep.
But I will say that the resi NPL is consistent, but the drip on the faucet has definitely slowed. So what then becomes kind of the new surplus? You've seen the Heckam space. I will say though, when it comes to RTL, fix and flip, DSCR, we don't love to be on the performing side. We want to be on the default side and the workout side. So we have been successful in not only that, but smaller GSE transaction as well. We're taking down a small Freddie pool. It's all Texas. Very rarely do you see them put stuff out outside of New York, New Jersey, Florida, Illinois, where this is an all kind of DFW, Houston, San Antonio focused pool. But those are singles and doubles. Now, one can argue that keeps you in the game, and
For sure. What's the game plan on that stuff? Is that modify a bunch of them? Like what is that like? Was that newer paper? Like the rates are more normalized? What did that look like?
yeah, originated paper from 2018 through COVID.
So low interest rates then.
Low interest rate that half the pool is looking to seek to modify.
Mm-hmm.
They're either in-flight mods that are handsome, good investment yield trades for us. However, half the pool is 65% LTV, haven't paid in 26 months. As you know, Texas is a restart state.
Mm-hmm.
But the majority of these, if you read the behavior and the commentary, is the borrowers are either being separated, going through some level of health concern, and they're looking to walk from properties that they have a 35% equity cushion on.
And then what are you doing? You're just assisting them through a consent towards foreclosure, and they get to keep the overage. I mean, why are they not?
I'd say, well, look, I would, from a workout and exit strategy standpoint, I'd say that half of these are going to try to raise their hand and ask for a cash for key, avoid the foreclosure altogether.
Do you have any kind of concerns? I know in certain states like California, there's the equity stripping concern. Like you can't actually take a deed in lieu if the property is worth more than what your payoff is. Do you have any of that issue in Texas?
You do not. However, you are seeing the increase in borrowers listing their properties now that we're in final diligence. The amount of recent listed homes in the last 60 days is pretty peculiar, just given that none of that behavior was happening over the last 24 months, right? So you are seeing that the fact that the paper is now going to get moved off the balance sheet of a GSE. What now happens when it gets to the private credit, and we're now a hands-on manager? right? Through
That
our
sounds like a
shareholders.
great trade for you, Chaz. I'm excited to hear more about how that goes.
And it's a small enough population, Bill, right? It's, sub 30 units where
Perfect.
you and I both know we can kind of get our hands around that in the first
Yeah.
180 days to really understand, the velocity of that paper.
That's pretty awesome. Keep me in, you'll have to come back on and let us use it as a case study, show us what you did. Because I'm sure, in that case where you got about a dozen or so that are in-flight mods, it flies in alignment with our philosophies about borrower interaction, guiding principles on how to run the business. You want to just speak to that? Because I know people hear it from me all the time. What is Chaz Guinn's paradigm for NPL operation?
We are definitely a for-profit operator. Um,
That's why
however,
you moved to Texas.
low tax was definitely of the mind. However, to remove all of um, the creative financing that this firm can be able to input into distressed residential credit environments, we are trying to work out the best solution for a delinquent homeowner. It is the most economical for us as a fund, and it is a far better win for that homeowner. Um, if you take a delinquent asset and get them to reperform, and you are able to buy that for a discount, and you get them to reestablish behavior of making payments, and that can last itself anywhere between 9 to 12 months, you now can retrade that paper or refinance that paper out at best at par, right? Less any fees. So
Hmm.
what a great financial outcome for us as a fund. But can you imagine what happens to that borrower being able to stay in the same school districts and not have to be, booted from the property they may have grown up in, right?
Right.
So there is an absolute approach that Revolve, and I know yourself, takes to keeping folks in the home and getting
Yeah,
them back on track, is the first and foremost uh, thing we're trying to do. Foreclosure is expensive. It's timely. We know it's a nature beast of what we do. We know that we have a lot of product we take back that is vacant. Foreclosure is a necessary evil that must happen. We
yeah,
are trying to clean up blight that we see throughout communities as well. And you're doing it throughout the nation. We're trying to do it. How best can we do that if we are just bottlenecked through the litigation foreclosure process,
that's
right?
true.
We want to be able to bring properties that first-time home buyers and folks that are looking to move and sell their homes and can move into, can tap into. So appreciate that question, because, you know, we've got too many win-win stories that we don't get to share.
Yeah.
And that is the better part of this business.
I know that's what's kept you and I friends over the years, is very similar approaches in the way that we are passionate about what we do and passionate about doing the right thing by people and making money for our investors at the same time. And all of those things can be equal. It's kind of like being, you know, Travis Kelce of the I had to bring up your history as a tight end, right?
No, the hamstrings don't work as much anymore.
Oh man, we both have a lot to do. I want to finish on one. I always finish with my bold predictions. It can be what crazy or expected. What do you think 26 is going to look like for us? It could be in our world. It could be broader. What to look. Here we are, the end of 25. I can't believe it went so quick. I mean, we all thought that we'd see a little more distress, we'd see a little more chaos. Somehow, we're still all here. And I don't know. You have a bold prediction for 2026?
Yeah, I got one that's fairly large. They're kind of two, but I think they go together. I do, to your point about distress. I think it's a slow wave, right? It's not sudden that we're seeing. We all expected, and we talked about this tsunami. It was never going to be '08. I've always hinted at it's going to be a cousin. It'll be a similar family member. And we've seen it show itself in ripples through credit card default, auto default, and we've seen it through the affordability on the wage gap we highlighted earlier on what people are earning versus what they today can afford. That gap is continuing to widen.
Right.
So that's a slow burning wave rather than it being such a knee jerk and a reactionary situation. Prediction wise, though, I do believe that technology will become the divider in our industry.
Mm,
I think that the next generation of NPL credit operators that are beginning to implement automation and AI and better workflows and real-time data, and not always working off legacy spreadsheets and going off their gut instinct, right?
Mhm.
I believe are going to be the separator in terms of where this goes. And I also think that real operators with track records that have gone through many different life cycles of this space are where we're seeing a flight of capital, whether it's high net worth family office through institutional capital. We've seen a flight to the private credit arena, that folks that have really faced some headwinds and have been able to navigate. And I
Well,
know
from
that's a
your
shameless plug, but
yep. I was just gonna say, from your good mouth to God's ears, that guys that have been through a couple of cycles up and down and have had the resilience to stick around in an NPL business that really hasn't existed the last year, been dominated by mega funds overpaying for the GSE loans and a lack of real inventory, that our day will come, and that I 100% agree with you in terms of the technology. It's gotten to a point where it's cheap enough, and there's old legacy systems that are either need to be redeveloped and improved, or just thrown away and replaced by the new era of technology. And it's either you get on the boat or you get left behind. And I look forward to what the next couple of years brings in terms of that. We're old dogs, but I'm ready for some new tricks.
we're seasoned. Come on.
That's right.
Yeah.
We're aged like a fine wine. I feel like we get a little older, finer with age. We also learn that the more we know, the less we really do know.
Thank you. Right. Exactly. I'll hide behind that all day.
Chaz, folks know how to find you through the information. Any last shout outs or any call to action? Are you looking for investors? Are you looking for deals? Are you looking for people to just stay in touch? Do you have anything that you want to say before we say goodbye?
I keep producing this type of content, keep bringing awareness to our space. There's not enough that know about it. They still view you and I as very nichey.
Yeah.
We are a specialized unit, but continue to get out the content and the word around this, because we could use it. So
thank you for joining the Debt Doctor, and Chaz, it's been great spending some time with you.
Cheers. Thanks for having me, man.
That's a wrap of today's episode of Debt Doctor. I enjoy bringing this content to you each and every week, and I really appreciate you tuning in. Remember to follow us so you get notified whenever new episodes release. If you haven't already done so, please share one of your favorite episodes with a friend, family, or colleagues. And if you don't mind, leave us a positive review on Apple, Spotify, or whatever your favorite listening platform might be. Until next time, thank you for investing your time with us on the Debt Doctor.